Let me ask you something. When you think about investing, do you think about slow, steady growth, or do you think about the excitement of high risk, high reward opportunities? Here's the truth. Both approaches can lead to success, but they come with very different journeys. The key is understanding which one feels right for you. There are two types of investors: those who take risks to chase bigger returns, and those who play it safe for steady, reliable growth. You might be surprised to learn that it doesn't matter what path you take. Success is still possible. The question is, which path will you take? Being an aggressive investor means you're not afraid to take risks in order to earn higher returns. You're the person looking for undervalued stocks, market inefficiencies, and special situations like mergers and acquisitions. But here's the thing, this is not for the faint of heart. The market can be brutal, and you can still end up losing. So why take the risk? It's not just about the money. It's about finding opportunities that others overlook. It's about being patient, making calculated decisions. Yes, managing real risk. It's not easy, but for those who can manage the highs and lows, the rewards can be huge. You're always looking for the golden opportunities. But here's the catch. When the market gets more competitive, these opportunities become harder to find. It's like hunting for treasure in a forest that becomes more and more crowded. Aggressive investors need to stay sharp. They're always calculating, always analyzing. The trick is to know when to pull the trigger and when to step back. But ask yourself this, is the potential of higher rewards worth the effort? For many aggressive investors, the answer is yes. But remember, this path requires a lot of skill, patience, and market sense. On the flip side, the defensive investor prefers safety over speed. You're not interested in the high stakes of chasing big gains. Instead, you value stability. Your strategy focuses on balancing risks and return with a mix of bonds and blue chip stocks. It's the slow and steady approach, where you're not taking unnecessary risks, but you're still set up for growth over time. This isn't about getting rich overnight. It's about building wealth in a way that's predictable and reliable. And in today's volatile markets, that can be a huge advantage. Defensive investors don't just lay back and hope for the best, they have a few tricks up their sleeve, like DCA or dollar cost averaging. This is when you invest regular amounts over a fixed amount of intervals no matter what the market is doing. It helps smooth out the highs and lows, so you're buying more shares when the prices are low and you're buying less shares when the prices are high. Another strategy? Diversification. You protect yourself against market volatility by mixing bonds and stocks. When one part of your portfolio dips, the other one can help balance it out. It's about minimizing risks and take the pressure off yourself, knowing your investments are working together in order to provide a profitable future. Here's the thing, aggressive investors and defensive investors can both achieve success, but the paths are very different. The aggressive investor is in a race, always looking for opportunities to outpace the market. The defensive investor is playing the long game, letting time and consistency work in their favor. The question you need to ask yourself is, what kind of investor are you? Are you comfortable taking bigger risks for bigger potential rewards? Or do you prefer to play it safe and watch your investments grow slowly over time? No matter what, both approaches have their place. The real key is finding the strategy that best suits you, your goals, your personality, and your financial situation. So which one are you? The high risk, high reward, aggressive investor, or the steady, careful, defensive investor? It's not about which strategy is better. It's about finding out which one aligns with you and where you want to go. Because whether you're in it for the big wins or the steady climb, important thing is that you're committed to your strategy. That's when the magic happens. When you stick with it, trust the process, and watch your financial future unfold.